Hello all. Welcome to video 2 for chapter 10. We've talked a bit about sort of the rules around RSPs, but this video we're going to focus specifically on RSPs, and we're going to talk about making certain contributions. How do we know how much we're allowed to make, etc. So let's go into some of the basic operations of RSPs. As far as the basic operations go, I think we've touched on the point a number of times about RSPs. The basic concepts is when you contribute, you deduct those contributions. If I contributed $10,000, I'm going to subtract that $10,000 from my income. The income earned within the RSP is exempt from Part 1 tax, and contributions and earnings become taxed on withdrawals. So how this functions is the RSP is structured like a trust, where there's an individual contributor, the person putting money into the account, an individual beneficiary, also known as an annuitant. The beneficiary is who pulls the money out, and the financial institution acts as the administrator, the trustee. They hold and at times manage your RSP for you. So the reason contributor and beneficiary are separate is because they're not always the same entity. Generally, they are. Usually, I will contribute to my own RSP. I am going to be the one to pull it out. The thing about it is there's a special scenario where I can use my contribution space to put the money into my spouse's RSP. So that's really the scenario where the contributor does not necessarily match the beneficiary. But outside of spousal RSPs, generally the contributor and the beneficiary of the retirement savings plan is the same person, whoever, it's for me. So when we make those withdrawals, the contributions and earnings, are taxed. So much like when you have a paycheck, if you get a paycheck from work, they usually have withdrawn a certain amount of taxes on it based on your assumed income. RSPs are the same way. When you make a withdrawal, the bank, the financial institution, is required to withhold a certain amount of that withdrawal in order to remit it to the government for taxes. Now, if I'm withdrawing for a home buyer's plan and a lifelong learning plan, they're not going to withhold the taxes because these items need to be repaid. But we will get into the HBP and the LLP later, once we'll start talking into various withdrawals further in the chapter. But generally, I'm taking money from the RSP. We need to withhold taxes. So we withhold 10% for withdrawals up to $5,000. So if I withdraw $5,000, they will withhold $500, and that will be applied against my taxes. If I withdraw between 5 and 15, let's say I take out 10, at 10%, it would be $1,000, but it ups to 20%. So at $5,000, they withhold 500. At $10,000, they would withhold $2,000. They would withhold 20%. And once I get above $15,000, they will withhold 30%. So if I withdraw $30,000, 30% of that is $9,000. So the percentage increases the higher your withdrawal. For the same reason that your tax rate increases on your paycheck, it's assumed income over time. But yeah, so I would say just note these thresholds. Under 5 is 10, between 5 and 15 is 20, over 15 is 30%. So if you're thinking about withdrawals from RSPs, just keep in mind the total amount withdrawn, and that'll tell you how much needs to be deducted. When you have an account with a bank, the bank will handle this for you. Withdrawals are included in net income as other income. So I've withdrawn $30,000. That's included in my income, and my withholdings of 30% are applied against my taxes. I can have the plan managed by the bank. They have people who are trained in investments and are able to, keep certain risk profiles. The financial institution holds the RSP trust property, and you can have only equity securities, long-term bonds, mixed portfolios. Really, what you invest in depends on a risk portfolio or a risk profile. So if you are a risky investor, you let your manager know, and they will apply a more growth stocks that have the big upsides but potential losses. Bonds are guaranteed. Not guaranteed, but bonds are very reliable returns, but they often don't return as much as certain equities. But you can decide how much you want to risk it, and they will manage the risk profile to kind of keep you where you want it to be. And over time, that might change. Maybe as you're young and you have a large time horizon, you're like, let's be risky with it. But as you get closer to retirement, you want less risk. You want to secure that portion because I'm going to retire next year and I want to make sure that money's there. If you don't want to manage plan, the thing about managed plans is they often have certain expenses. You're paying for someone to manage the plan for you. So that can eat against your returns a little bit. Hopefully they make more than what you pay for them. So there's also self-administered plans. So you put into the account, but you manage it. You decide which shares you want to buy into. If you're like, I want my entire retirement plans in Starbucks, let's go for it. But if Starbucks loses money, you have no one to blame but yourself. You can contribute personally owned investments, however, subject to fair market value disposition rules. Because the change in value of investments are not taxed while in the RSP, you can't, if I have a share that has a large gain, I can't be like, ooh, let's put it in my RSP. I'll sell it in there, have a big gain and not pay taxes on it for now. No, once you transfer shares from a personal account into an RSP, it's deemed sold on that date. So you will recognize any change of value, and then any further change will not be taxed, or at least deferred tax until you withdraw the money. In an RSP, you can have publicly traded shares, mutual funds, bonds, mortgages, if they're insured, warrants, rights. The reason publicly traded shares are allowed, but shares of private corporations are not allowed, is because I have control of, if I own the private corporation, I have control of how many dividends get paid out. So they don't want someone just being like, well, I'm going to put my corporate shares into an RSP, declare $1 million of dividends and not have to pay the taxes. Publicly traded shares, I don't have the control. As long as I own less than 10%, I don't have the control to influence decisions on that part. So the income I gain is just a matter of investment outcome. I can't play the rules. I can't find the loopholes. I can't decide the income. So since the controls are not in my hands, then it can be in an RSP. If I own more than 10% of those shares, it's expected that I'm able to influence the outcomes of those decisions. I'm a large enough shareholder that the board of directors will listen to what I have to say. Not control, but at least influence. So at over 10%, I need to pull it out of the RSP and just have it in my personal hands. Mutual funds, bonds, bonds and mortgages have a stated income return rate. I don't control it. And warrants and rights can also include income. Mostly it's about control. Set income amounts can be in the RSP. Now, the thing about RSPs is they are 100% included in income when I take them out, which means I don't get the preferred tax treatments that capital gains and dividends get. Capital gains are only 50% included in income, so their highest tax rate's like 26%. And dividends come with dividend tax credits. But because my income and my taxes are protected, I don't get those credits. So if I have a $1 million capital gain, it would only be included 500,000 in my income if I earned it personally. But if I put those shares in my RSP, earn $1 million on it, when I pull that $1 million out, it's entirely included in income and I'll have to pay standard tax rates. So I'm gaining the benefit of tax deferral, but I'm losing out on those special tax treatments. And I mentioned in the last video that financing costs are also not deductible because financing costs apply against the income earned. Since I'm not declaring the income in each given year, I don't get to subtract the financing costs. So when planning your investments, you might want to plan that, okay, my interest investments, they're going to be 100% included. Maybe I want those in my RSPs, but this share that's going to have a really large gain on it, maybe I want to hold that personally so I can protect half of the gain. And these are the considerations when making tax planning. That being said, because of the tax deferral gains, maybe it's still worthwhile having those investments in the RSP. Okay. Now let's get into the fun math stuff. How much am I allowed to contribute to an RSP? The thing about RSPs is it's cumulative. Every year, it will calculate how much you're allowed to put into the RSP, and that amount will add to any unused portion. So if a given year it says I can contribute 20,000, I don't, next year, the calculation says I can contribute another 20. That means I can contribute 40 altogether. So it accumulates every year. If I get that initial 20, I put 5,000 in. Well, now there's 15,000 left. So when I get the next 20, 35,000 can be put in. So for every year that passes, it accumulates a certain amount of contribution space. So we always start with how much unused deduction space do you have? If I'm left with 15,000 from last year, I have 15,000 this year. I start there. We will look at RSP dollar limits in the current year. Basically, we're saying you can contribute up to 18% of earned income for the previous year. So their contribution will take your income. Let's say you made $100,000. You can contribute $18,000. This is reduced by pension adjustments. We'll talk about that in a second. But pension adjustments are basically, I'll talk about how we calculate it, but what they are is when your work contributes to an RPP, it uses up some of your contribution space. This deduction limit is saying how much of your income can you protect by putting it into a pension plan. So if your work is contributing to a pension plan, they don't want someone who has their own RSP and then also getting an RPP. They're duplicating their benefit. Not everyone will have access to that. So if your work is contributing to a pension plan, they're using up some of this deduction limit. And we'll go into how we calculate how much they're using. The same with past service pension adjustments. So let's say they're changing your benefit. Your benefit was 2%, but now it's gone up to 3%, and it's retroactive for a certain number of years. Well, it's used up some of your contribution space. And pension adjustment reversal. If you lost out, let's say you worked at a place that had a defined benefit pension, but due to one reason or another, you lost access to it, or you didn't vest long enough to gain it. You left the job after 3 years, you had to stay there for 5. So every year I've been I've been having a pension adjustment against my deduction limit, but then I lost access to that pension. Well, we can take that adjustment, we can take the pension adjustments we have been deducting, and we can add them back. Okay, so, but for you guys, we start with what is our balance at the beginning of the year plus 18% of earned income. Contributions made during the first 60 days of a year can be deducted against the earnings of the prior year. So RSPs are a savings amount, but how much can I contribute? Maybe I don't know until I get to the end of the year, figure out how much income I have. So they give this 2-month, this 60-day time period into next year where you can contribute and have that deduction applied against the previous year. So for 2023, I don't file that tax return until April of 2024. So if I have some deductions or contributions in January and February, I know what those are. I can include them on my tax return. So you have this 60-day grace period in the next year to subtract from your previous year's income. So 2023 can be deducted against RSP deduction limit for 2023. The deduction limit for 2023 is based on the income from the previous year. Because there are penalties for over contributing to an RSP. Because of these penalties, if they use the same year, I won't know what my 18% space is until I know what my total income is. So I would be contributing based on estimates through the year. So if I turned out to be wrong, that could have serious ramifications. So they say, okay, use 2022's income in order to calculate 2023's contribution space, because that income is known. It's not going to be based on estimates. I know what I'm adding to my space. So we always use the previous year's earned income to calculate this year's contribution space. It's based on earned income for previous year, as well as pension adjustment calculated using 2022 amounts. Unused contribution space is cumulative, so any amounts you don't use are available to the current year. Anything you don't use last year is available this year. Less amounts deducted in those previous years. There's no carry forward time limit. You don't have to use the space. Anything I'm not using through my 20s and 30s, if I hit 45, all of that space is accumulated, and maybe I can put $200,000. Maybe I sell a property, make a bunch of money so I can add a whole bunch into my RSP and deduct it this year. This is how much. Now, we calculate 18% of earned income, but someone who makes $1 million, we don't want them contributing $180,000 to their RSP. So the dollar limit or the amount of contribution space is limited. The money purchase limit is slightly higher. It's the annual limit for contributions to RPPs because you and your work are adding to it. Their limit is slightly higher. But basically, the money purchase limit in a given year, 2020, is the RSP dollar limit for the next year. So, however much that your RPP contributions have used up this year will count against your next year limit, right? So there's kind of this 1 year timing difference. So 27,830, 27,830, this 29 goes to the next year, 31,560. So your limit of so how do I want to say this? So when using 18% on earned income for $100,000, that's 18,000 a year. So in order to hit these maximums, you would need to be making significantly more. So for 2024, the limit is 31,560 divided by 0.18. So you would need to make $175,000 to hit that limit. So for many of us, for most of us, we're not really hindered by the dollar limit. It's just based on our income. So anyone who makes up to 175,000 can save 18% of that earned income by contributing to their RSP. So I keep saying earned income. What is earned income? So earned income is based on your active income earnings. So there's passive income, such as interest and dividend investment, but I didn't work for that income. I just own the shares. So RSP is meant to save for retirement. It's safe to, you are working for your money, but at some point you're going to stop working for it. So you can save based on the income you actually have to provide labor and effort to earn. So so in earned income, we include employment income, we include income from carrying on a business, business income from active partnerships. The strange thing about earned income is it does include rental income from real properties, even though rental income is often considered a passive income. The term earned income we would have seen in the previous chapter when discussing childcare expenses, because childcare expenses also uses the concept of earned income. You can only deduct childcare against earned income, but that list of earned income does not include rental. So the Tax Act uses earned income in two different scenarios, and they actually are different. They're not too different. Basically, rental income is the big difference, and royalties, I think. You can include royalties and earned income if you are the creator of the work. If I write a play, I get royalties whenever that play goes on stage. But someone can buy my rights. They can buy that right to royalty. So if I purchased someone's play and I earned royalties when they put it on in some theater across the country, those royalties are not a part of my earned income. So if I wrote it, if I wrote the song, if I wrote the play, if the royalties are an outcome of my labor, then I can include those royalties in earned income. If they're not, if I purchase those rights, they're not a part of earned income. Spousal supports received are also added to earned income. It's being subtracted from my spouse's income and added to mine. Alternatively, spousal support payments I pay can be deducted from earned income. So deductions are current year losses from business, current year rental losses, current year business losses from partnerships, and spousal support payments. Spousal support received included, spousal support payments deducted. So that will tell us our earned income, and we can accumulate 18% of that against towards contributions. All right, pension adjustments. There are two. I do want to get into it. So we're going to push through because I want to do pension adjustments in this video. If you have a money purchase, which is a defined contribution, your work isn't promising you an amount. They just put, say, $2,000 against your pension plan. So the pension adjustment for money purchases just applies against the contribution. So if they contributed $2,000, they used $2,000 of space, right? That's just a deposit you didn't have to make. So money purchase or defined contributions are very straightforward. For every dollar they put in, we subtract $1 from your contribution room. Defined benefits are slightly different because a defined benefit is I've earned 2% of my salary. That's going to go into my pension benefit. So if I'm going, how would I say this? So when I retire, I'm going to get $1,000 a year. I'm going to get that $1,000 every year. So the amount that I'm withdrawing or getting from the pension probably doesn't match the amounts being put into it. So it's not so easy to say, well, they contributed 2,000, I'll subtract 2,000. So the process the CRA has come up with is for every dollar of pension benefit earned, you use up contribution space of $9. So we always just take whatever the benefit is, the increase, and multiply it by 9. So in order for my benefit to increase $1,000 per year of retirement, I contributed $9,000 this year. So it uses up $9,000 of contribution space, but I've earned an extra $1,000 of income when I retire. Regardless, it's up to the employer to make sure I get that money. So there's not too much risk, but it uses up contribution space at a much faster rate. Pension service pension adjustments, reduction to RSP deduction limit for past service benefits, and pension adjustment reversals. I've mentioned before that sometimes defined benefit plans, they're like, hey, you get 2% of your income, average salary, but maybe they increase it. You're going to get 2.3%. Well, we've been calculating contribution space based on 2%. So we need to calculate what's the result of the 2.3, figure out and basically subtract from it that 2% calculation. At the time being, I don't know if there's any questions on the pension adjustment reversal or past service pension adjustments. Pension adjustment reversal is the same way. Instead of 2%, maybe it dropped to 1.7. So we need to add back that contribution space. But I can't think of the top of my head of any questions related to this, but I do want to show you pension adjustments calculated. So let's do a couple exercises quickly and before we finish up this video. Exercises 10.2 and 10.3 are focused on earned income. So Mr. Nakari has employment income of $56,000. He's not a member of an RPP. We're specifying RPP because we're often told income on a net basis. So employment income of $56,000, net $4,000 to an RPP. Well, then the earned income is $60,000. RPP contributions from your employer are often subtracted from income or not included in income. So we need to make sure we're dealing with our full gross amount. So 56,000, he's not a member of an RPP, so there's no modification to this. Interest income of 22,000, rental income from a residential property of 2,500, and he receives spousal support payments from a former spouse of 12,000. So we're trying to think of what income was earned. Employment income definitely earned, so we're going to include 56,000. Interest income is not considered earned. Rental income is earned for purposes of RSP, and spousal support payments from former spouse. He received $12,000, which will be included. So when we look at the spreadsheet, I have them both here. Employment income was 56. We had rental income from property, 2,500, and we have spousal support received 12,000. So our earned income is 70,500. So our contribution space will add 18% of this next year. We are going to exclude these passive amounts. So this interest of 22,000 is not going to be included. So if we take that 70,500 times 18%, we're going to add 12,690 next year. For 10.3, during the current year, Miss Shelley Devine has employment income of $82,000 after the deduction of $3,000 in RPP. So this $82,000 including a deduction, we need to back it out. So for 3,000 plus 82, the gross income must have been 85,000. A business loss of 12,500, taxable dividends of 4,200, and she pays deductible spousal support of $18,000. So we look at the income. So the net employment income was 82,000. We're going to add back that RPP deduction. The income loss from a business was 12,500. We lost money, but it was from an earned activity. So we get to subtract that loss. And we paid spousal support of 18,000. We're not including the dividends of 4,200, so the total earned income is 54,500. If we were to consider 18% of that, we can add $9,810 to our next year's RSP contribution space. I also, do I have time? Yes, I do. I also want to do 10-5, which I believe. For here, we're going to calculate pension adjustments. So Mr. Arnett's employer sponsors both a defined benefit RPP and a deferred profit sharing plan. During the current year, the employer contributes $1,800 to the DPSP on behalf of Mr. Arnett. The pension benefits accrued in the year under the defined benefit program was $600. So my pension income every year after I retire will increase by $600. Mr. Arnett contributes $2,300 to the RPP and the employer an equivalent amount. Calculate the amount of the pension adjustment that will be included on the T4. The thing about contribution plans is they're often based on a matching principle. So because Arnett contributed $2,300, the work will contribute $2,300. So they usually say we will match up to a certain percentage of your income, say 2%. So what does that mean for the pension adjustment? There's two, we have benefit plans that have both forms. We have a defined benefit and we have a contribution plan. So for the money purchase, the defined contribution, they contributed $1,800 to the profit sharing plan and another $2,300 to the RPP. The employee, Arnett, contributed another $2,300. So he had that deducted from his paycheck at work. So the pension adjustment is $6,400. We have a certain amount of contribution space and we used $6,400 through work. But we also have a defined benefit plan. So what we need to know is how much did our benefit increase? Well, it increased $600. So the contribution assumes that we must have applied 9 times that amount into our capital base. So the multiplier times 9, the pension adjustment for the defined benefit plan is $5,400. So defined contribution is easy. Any dollars we put in, those are the dollars that are adjusted. Defined benefit, we need to know the change in the benefit and we'll multiply that change by 9 to get the pension adjustment. So assuming that the person had income, let's just say $68,000, we'll add back the RPP deduction, 23. That comes to earned income of 70,300. Times 18%, the deduction limit was 12,654, but we used 6,400 and 5,400, which is 11,008. So our earned income calculation says next year's contribution should be 12,654 or contribution space. But our pension adjustment says you used 11,800. So your increase to your deduction limits only going to be $854 next year. So when we save for retirement through work, that's using up our contribution space for our calculation. Okay, that brings us to just about 30 minutes for this video. Thank you for your time. I will see you in the next video where we will continue to discussing RSPs.